Everyone, it's Matt Williams from JTM Williams Capital Management. This video is your recap for February 2026. As a reminder, the securities and indices mentioned in this video are for illustrative purposes only and do not constitute recommendations. Please refer to the disclaimer at the beginning and end of this video. Originally, this video was going to be a deep dive on private credit and what's going on in the bond markets, as that's something that everyone's been talking about here in the last few weeks. But over the weekend, the U.S. military launched some strikes against Iran, and that has altered what I wanted to discuss. It looks like geopolitics are going to take the lead here this week. So as a result of that, I want to take a look at the chart of oil and commodities and just run through some relative strength charts as we have the last few videos, and I'll just finish up with some closing thoughts. So let me just go ahead and please, I'll share my screen. So, we'll start off just by looking at the S&P 500, and not a whole lot's changed here, even though a lot's changed under the surface. We're still just trading in here between 6,700 on the downside and 7,000 on the upside. Even though it's been relatively calm at the index level, there's been a whole lot of movement again under the surface. Now, obviously, as I mentioned at the beginning of the video, what I want to, discuss is, the big, event that's happening here over the weekend with what's going on in Iran. So, of course, what everyone's going to discuss is what's going to happen with oil. It looks like right now, based off of over-the-counter markets here, I'm recording this on Sunday, March 1st, that it looks like crude oil is going to potentially open up somewhere, between $75, $80 a barrel. If that's the case, then we've, effectively broken this downtrend that oil's been in here for several years, and, could potentially end up breaking the streak of lower highs and lower lows, which, could end up portending again, obviously, for higher energy prices. We purchased oil through a commodity ETF for our clients here about 2 weeks ago. So, we'll have to see. The last time this happened, last at the tail end of last June of 2025, it ended up being a sell the news event. It spiked up relatively violently, when the U.S. took out Iran's nuclear facilities, and then we quickly faded. We'll have to see. Sometimes that's what happens if the market thinks this is going to end up being a pretty short-lived campaign. Oil will spike up and potentially end up fading here by, tomorrow, middle of the week. We don't know. We'll just have to see, how things progress and take it day by day. What I will show here next is oil and energy commodities are really the last thing to go. If you've looked at what commodities as a whole have done really here in the last, year or two, precious metals have rallied strongly, base metals have rallied strongly. Agricultural commodities, while they've gone sideways for the last year, are up pretty substantially in the last few years. So, again, oil has really been the last thing to go, and if that rallies, I think it's going to end up filtering into a lot of things. So again, we'll just have to keep our eye on it. Going back here real quick just to go over the equity markets. Again, not a lot's changed here as far as relative trends. It's still value over growth, international over developed. As we can see here down at the bottom, again, as I just mentioned, commodities have started to rally relative to the S&P here in the last month. If you start breaking it down here again, at the factor level, again, value over growth, defensives have started to outpace, growth in the broad indexes. Again, that's something to keep an eye on. Equal weight continues to outperform cap weight here since Halloween. Again, growth momentum are lagging. Moving on again, we'll just go over sectors real briefly again, because again, not a whole lot's changed. Technology still lagging. Defensive cyclicals continuing to outpace. We're still going to have some issues with the broad markets, going higher, as long as technology and financials, which are pretty big weightings in the S&P, continue to have issues. Now, with financials, what I'm going to get into here a little bit later, it is potentially related to what's going on with private credit, junk bonds, credit spreads. Again, moving on, as we see with this last one, again, REITs, industrials, it's, effectively the same thing here as last month. And you still go on, semiconductors, really the only offensive parts of the market that are continuing to show relative strength. What's going on with private credit is very much a software story. Again, we'll move on here. So, what I wanted to talk about, again, everyone's been discussing private credit, the last few weeks, and it seems to start to be seeping in potentially into equity markets and financials and whatnot. Without taking too much of a deep dive, long story short, equity follows credit. If there's a credit event, typically that's what ends up causing fairly major drawdowns in the equity market. As we can see here, just going back to 2011, every single time junk bonds break their long-term moving average, we tend to have some type of a drawdown in equity markets. And you can go back and just look, Q4 of 18, COVID, the bear market in 22, the tariff tantrum last year. And this can even be affected even with bank loans. So bank loans are slightly better credit quality than as liquid as junk bonds, but same story. Every time that either junk bonds, bank loans, etc., start breaking their long-term moving averages, there tends to be a drawdown in equity markets. So again, just something we'll have to keep an eye on. Moving forward here, just to kind of get into credit. What this chart is up top. These are effectively the business development corporations, effectively private credit companies. As you'll see here, while the S&Ps continue to push higher here in the last few months, you're seeing a pretty big deterioration in private credit companies, private equity, and we have to just keep an eye out for if these trends continue, if there ends up being more of a contagion in terms of these loans these companies have made, which are predominantly to the software companies that are starting to be disrupted now, due to a lot of thoughts on what artificial intelligence could end up doing to them. If we have a credit event, we potentially could end up seeing a further drawdown in equity prices. So again, no guarantees, but just something to obviously be cognizant of. Now, the issue would be, okay, well, how do we hedge ourselves against this? What's something we can do, if I can't short junk bonds or whatnot? Well, easiest thing is I'd say, buy treasuries, potentially, look at reducing risk in your credit portfolio. As far as a trade, what I'd like to show here is the blue line is the volatility index. The red and green line is the credit spread. So effectively, it's what's a high yield bond yielding relative to treasuries. If the line goes up, that's credit spreads blowing out. That's people seeking the relative safety of treasuries. They're selling high yield. And as you'll notice, there's a pretty high correlation here between the junk bond spreads and the volatility index, which again makes sense. Obviously, if the market thinks there's going to end up being a credit event, then they're going to run and they're going to hedge. So potentially the easiest thing that we could do, without getting into buying some specific products that a lot of retail investors don't necessarily have access to, would be, buying volatility to hedge ourselves. So something, again, keep an eye on. Just bear in mind, trading volatility is extraordinarily difficult, because it mean reverts, it doesn't trend. I'm someone who I'm a big trend follower. So again, with the buying the VIX, it's something you've got to keep a very short leash on. So obviously, as far as like the recap with February, going from February to March, just need to keep an eye on the relative trends that are continuing. And obviously the big news here over the weekend, with the geopolitical event with the U.S. striking Iran, all eyes are going to effectively end up being on crude oil. And obviously by the time this video posts, we'll have a pretty decent indication here on what happens when the futures market opens up here on Sunday evening and then into the cash open Monday and the rest of the week and the month. So as we can do, all we can do is just take it one day, 1 week at a time, make adjustments as needed. If anybody has any questions or wants to discuss this, I can be reached at matt@jtmwilliams.com. My phone number is 703-782-3110. Happy to answer any questions you may have or want to set up a complimentary consultation. That's it here for this month. Hope everyone has a great week and great month.